It is observed that at every trend change, there are points of either tops or bottoms. Momentum plays a crucial role in defining the trend change as it leads the price most of the time. Whether the price is breaking down or turning up, it usually occurs on a momentum chart before it becomes visible on the price chart, leading to excitement among traders. To capitalize on such opportunities, it is advisable to be present before the crowd gets excited. Generally, the focus is on long-term trends rather than day-to-day fluctuations. We cover all four major asset categories, namely the debt markets, foreign exchange, with a particular focus on the dollar-euro pair, commodities, especially gold and silver, and the stock markets. The reason behind this broad coverage is quite apparent. It has been evident to us for a long time that many times, if you are solely focused on a particular market or sector in the stock market, you must keep in mind that other factors are at play in other asset categories. It is not just about what you perceive is happening in the stock market, but it's also important to understand the impact of debt markets, foreign exchange, and commodity prices on your stock position. These are external factors, but they are significant and real. Therefore, it's crucial to analyze other categories, regardless of which market you are heavily invested in, because they will undoubtedly have an impact on your investment. However, sometimes the connection between these categories may not be apparent, but it's still important to consider their potential impact. There are times when fluctuations in interest rates may not have a significant impact on the stock market, while at other times, it can become quite acute. We are currently in one of those acute phases, where everyone is fixated on what the Fed will do in the future. It seems as if the Fed is being viewed as a godlike figure. However, we must acknowledge that although the Fed can provide support for some time, there are instances when its power diminishes. For instance, during the 2000 to 2002 and 2007 to 2009 bear markets, the Fed's efforts to save the market were unsuccessful. Bear markets typically begin as an arm wrestling match where it's unclear who's winning. If the Fed perceives that the stock market is becoming too risky, and investors start moving their assets to other categories, which is already happening, then the Fed will have a problem. This is because the stock market's fluctuations can have a significant impact on various economic indicators such as unemployment. Any talk of tapering will then be thrown out the window. If anything, it appears that we need to step harder on the gas pedal. It's intriguing to note that the two best alternative markets to the stock market right now are gold and T-bonds. This was particularly evident during last year's market collapse and before that. What does this signal to us? It suggests that large asset managers, who are seasoned players and do not follow trends blindly, are being cautious and have started to shift their assets to safer havens. People like Ray Dalio have warned us not to be overly concerned about the stock price but rather to focus on the value of our money. Even non-gold bug investors have started to shift their assets to safer havens, such as T-bonds and gold, albeit not on a large scale. I can see the evidence of this shift in the behavior of T-bonds and gold. This indicates that skeptical asset managers have started to transfer some of their assets from one market to another. If the stock market continues to weaken, we will see more of this. These asset managers have to put their money somewhere, and it's evident that they are buying T-bonds for safety rather than yield, and gold because it has been leading the inflation event. Gold even led the commodities up by 2 years before they turned up. In my view, this is another reason why it's crucial to consider all four asset categories, as they can have an impact on one another. Although the Fed may initially set the direction of the river flow, ultimately, it's investors who can divert the flow to where they want it to go. A good example of this is 2009 when the stock market hit rock bottom during the bear market, and although stocks were cheap, we became bullish based on technical analysis that indicated it was the right time to buy. The river flow had already been set by the Fed, but that didn't prevent the bear market from continuing. At this time, investors bought both stocks and gold. In the years that followed, gold outperformed the stock market. This was not just a coincidence. The market had collapsed, and the Fed's easy monetary policy had decreased perceived risk and increased potential rewards for investors. However, now we are experiencing one of the longest bull markets in history, sustained by loose monetary policy. The question is whether investors and asset managers believe this can continue indefinitely. Based on history, they know that the Fed doesn't always have control. They remember the 2000 bear market, where the Fed tried to intervene but failed. We may be at a similar point now. If the market goes down and the Fed continues to create more liquidity, investors may not follow the intended path. Instead, they will likely divert to other asset categories, such as gold, silver, and possibly Bitcoin. That's why it's important to consider all four asset categories and how they interact with each other. Rebuilding the commodities market will take time, and the surge in commodities is not a temporary phenomenon. Most commodities moved in synchronization, exploding almost simultaneously. Sugar, copper, and oil all turned up, indicating a broader trend in the commodity category. The upturn in commodities was driven by monetary policy, and if the stock market falters, the same policy will likely continue, leading to a renewed focus on the commodities market. When measuring commodities such as the Bloomberg on an annual momentum basis, it has only recently broken out. Such momentum trends usually last for a few years. For example, the last major turn in the Bloomberg was in 2011, coinciding with gold, and it took several years to decline. We believe the same trend will be true on the upside, but it may take less time to complete, possibly 2 years instead of 5. Additionally, we assume that this emerging trend in the commodities market will not be incremental, but rather a significant shift. The impact of monetary policy on commodities is significant and may result in a compressed uptrend in these categories. Gold, for example, had a gradual increase from a low of $10.54 in 2015 to doubling to 2000. The growth was incremental, with small bursts and pullbacks. We expect the next year and a half to be interesting as many assets will move significantly. However, we caution against getting too enthusiastic until the chaos period when things start moving fast. We anticipate a normal bear market for the stock market, leading to a rise in alternative markets. We may face a crisis that creates doubt about the necessity of the Fed, and even the ECB, as comments from Europeans, particularly Germans, may emerge. To put it differently, the monetary policies implemented in the past have not been successful. Even if Nixon had not ended the gold standard in 1971, the events of the last 50 years would not have been stable. In fact, central banks have contributed to the boom-bust cycle by creating too much money in one direction, and then too much in the other. I believe that there will be intellectual doubt from various parties about the effectiveness of these policies. This doubt will be fueled by examples of former communist countries such as China, where currencies are backed by gold or are non-fiat. Even Bitcoin is finite, unlike the dollar, which can be infinitely printed. The next crisis we face will create a wave of intellectual doubt among economists, academics, and even ex-Fed officials who will argue that there must be a better way to have money that doesn't require top-down control.